get across to Chicago for more on how markets reacted to the vote and commodity markets as well. Larry Shover from Efficient Capital Management joining us now. Larry, we've got that austerity vote through. You would say, more importantly, the vote on implementation must be ticked off for these markets now.
Yeah, absolutely. And that all starts tomorrow, and it's not going to end in one day. That's going to be the key vote. What happened yesterday morning was basically factored into the market. I think most people expected it to pass. I think what happened to the commodity markets, and especially with our equity markets, is that it all started in Japan, actually, with the strong industrial production number that came out. I think Americans generally factored in that this vote in Greece would pass.
So you think actually that Japanese number was more important than actually what went on with Greece overnight? That's interesting.
I do, because like for me, it just enforces the fact that the V-shaped recovery is indeed in place, and you could see it in the copper markets. What happened last night in copper, with some of the other ones I don't follow as closely, but iron, zinc, and steel, but especially copper. You see the industrial production number came up pretty strong, and it removed an overhang for the commodities market, and the Greek austerity vote was just icing on the cake, if you will.
How long does even that high from the industrial production number out of Japan last, though? You get manufacturing numbers out of China, out of the US in coming days, and they might only serve to remind people of some of the struggles of these major economies.
Yeah, you know, and I think what it's done, if I could say, is that people are very rattled and braced for the PMI number that's going to come out on Friday. But you're right, with the amount of numbers that have been coming out of China and Japan, what we saw was a sliver of good news that's going to affect the commodity markets, affect the recovery. And maybe I'm reading into it too much, but my take was that all systems are go for base metals and industrial metals right now.
Just to linger on the Greek issue, though, the French government and some of the banks have come up with this plan to roll over Greek debt. Are we getting any vibes at this stage, though, of what the ratings agencies think of all of this? Because ultimately everyone points back to them and says that's what really counts.
Yeah, you know, that's the million-dollar question, because it all sounds good on paper. And then when I read that the rest of the European Union is on board with this, there's something that just doesn't sit right. And I think, you know, they're all saying, well, we'll do this if it's not a junk rating. But the fact of the matter is, how can you get these rating agencies to do anything but junk right now? So right now, it just seems to be smoke and mirrors, but a very good point indeed.
Hi Larry, Chris Stott here from the studio in Sydney. We've seen the market bounce strongly in the last few days, expecting this vote to go through overnight, which it did. I mean, on very light volumes. I mean, to what extent do you think this recent rally has legs, given the volumes are very low and are reflective of holiday periods?
Now, Chris, if you're talking about the U.S. equity market, I'm assuming you are. We're in a really technical market, and as a trader, I don't even like to say that term, but the fact is we were in 1250, 1260 area in the S&P last week, a very key support. We bounced off that. Right now, we broke through an initial resistance of like 1300 in the S&P, climbing towards like 13.25. It seems like that's in place right now, given that our numbers come out. We don't have any kind of earnings for 2 more weeks. I think it does have legs, and as I've said a few minutes ago, we are bracing for a bad PMI number, so any glimmer of hope that says that's not correct, we'll be off to the races.
To what extent do you think we're seeing short covering, Larry? Obviously the market's had a pretty a tough 6 weeks with a lot of shorting action out there. To what extent do you think the recent rally has been driven by short covering?
You know, in the last few days, there's been very little short covering. Actually, the action's been really macro focused on ETFs and futures. There hasn't been a whole lot of single stock action, at least to the desks that I talk about or talk to during the day. It seems like most big players are on the sidelines, but there is a macro focus to ETFs and future-related equities.
Can we ask you more specifically about gold as well, Larry? Today, rising after the vote, but also it seemed that Obama was calling for more stimulus. He's been talking about some job creation plans, even as the talk over the debt ceiling kind of goes on. Where do you see this gold price headed? What is it actually taking its cue from?
You know, at the end of the day, I do believe that the bullish momentum in gold is in place. Even though we're only at 1511 per ounce, there seems to be a lot of demand support at 1500, 1475. But if you're like me and you believe that gold at the end of the day is the casual driver of global liquidity, and if you believe that money around the world, except for Australia and Canada, if money around the world stays cheap, then why can't gold rally? I mean, right now it's fallen a little bit in the last week because people were disappointed about Bernanke, so on and so forth, and it seems like the sovereign debt issue might be under the rug for a while, but the bullish trend definitely is in place. Right now is probably a good buying opportunity.
Yeah, we spoke to one of the traders, Alan, from the floor of the New York Stock Exchange again today. He still says QE3, and it'll come out in August. You just talked of the money supply continuing, or the money continuing to be cheap. What are you saying in the next year or two out of the US happens with monetary policy?
I think what they're going to be forced to do, for a lot of reasons, is take the money that they're getting off of principal payments and perhaps investing in a longer end of the curve. Like right now, or QE2 actually was basically a 5 to 7 year duration, which they were purchasing. I think the least path of resistance for them would be perhaps buying like a 10-year or even beyond. And what that would do to the market, the broad market actually, is showing that they want to keep inflation low, and it wouldn't upset the whole apple cart. I mean, I still don't think it's the best way to operate, but given what they have in their toolbox, it might be the most sensible way to operate.
Thank you so much, Larry. Great to get your thoughts on that today. Thanks.